Welcome to the deep dive. Look, if you're involved with a business, especially when using trusts, you might be feeling a bit, well, overwhelmed by all the compliance talk lately.
Uh-huh. It's a lot to track.
You're definitely not alone there. So today, we're going to try and, cut through some of that complexity.
Absolutely. Trusts are powerful, no doubt, but things like the Corporate Transparency Act, the CTA, they've definitely added new layers. You really have to pay attention.
And that's our focus for this deep dive, getting a handle on the compliance rules for businesses owned by trusts, specifically under the CTA. And this isn't just bureaucracy.
No, not at all. Getting this wrong can lead to some, frankly, scary consequences. We're talking serious money.
Like, how serious?
Well, the sources we looked at mentioned potential fines hitting $500 per day, and even the possibility of criminal charges in some cases.
Wow. Okay, so definitely not something to ignore.
Definitely not.
To figure this out, we've gone through quite a bit of material, legal updates, industry reports, info from companies that actually help businesses with this stuff, trust compliance and the CTA.
Yeah, we tried to get a good cross-section.
So our mission today is pretty straightforward. Explain what the CTA means for trusts, figure out who exactly needs reporting, point out some common, maybe easy to make mistakes, and look at what tools or strategies can actually help.
Right. Make it manageable.
Okay, let's dive in. The Corporate Transparency Act. When a trust owns part of a business, what's the main idea? What's the government trying to achieve?
It really boils down to transparency. The government wants to know who the real people or the beneficial owners behind a company.
The actual individuals.
Exactly. Who ultimately benefits from or controls the business, even if it's held through something like a trust. The CTA is designed to look behind the curtain, so to speak.
So just saying the Smith family trust owns 30% isn't enough anymore.
Nope, not quite. The law wants to know about the people involved with that trust. Specifically, if a trust owns, say, 25% or more of a company.
Okay, 25% or more.
Or if it exercises what they call substantial control over the business's big decisions, then you need to report the individuals connected to that trust who qualify as beneficial owners.
Right, substantial control. We'll probably need to unpack that a bit more. But first, what kind of information are we talking about? It's more than just a name, right?
Oh, yeah, it's pretty specific. For every beneficial owner you identify, you need their full legal name, their date of birth, their current address, residential or business street address.
Street address, okay.
And a unique ID number from an official document, like a passport or a driver's license, and sometimes even a copy of the ID document itself.
That's quite a bit of personal data.
It is. It underscores the seriousness of the requirement.
Okay, so the big question then, who is a beneficial owner when a trust is involved? This feels like where it could get tricky.
It definitely can, especially with, more complex trust setups. But generally, you're looking at a few main groups.
Like who?
Well, the trustees, the people actually managing the trust, making decisions about the assets according to the trust rules, they're often considered beneficial owners.
Makes sense. They're in charge.
Then you have the grantors or settlers, the people who originally set up and put assets into the trust. Depending on the specifics, they might count too.
The creators of the trust, right.
And then certain beneficiaries, this is where it gets nuanced. It's not usually all beneficiaries, but often those who have, again, that substantial control over the trust.
Maybe they can tell the trustee what to do.
Kind of, yeah. Or maybe they have the right to demand distributions, or they stand to get the bulk of the assets. It depends on the powers they have.
Can you give us an example, maybe something from the sources we looked at? Like who specifically gets reported?
Sure. Think about someone who, under the trust agreement, has the final say on selling major company assets held by the trust.
Okay, like a big decision.
Right. That person likely has substantial control and would need to be reported. Or someone who has the power to appoint or fire the senior officers of the company owned by the trust. That's another clear indicator.
So it's about power and influence, not just receiving money passively.
Often, yes. It's about who holds the reins or has a significant economic stake tied to control.
What about some of those edge cases? Our sources mention things like beneficiaries who are still minors or just regular employees.
Good points. The sources suggest that minor children are generally not reported as beneficial owners initially.
Okay, so kids are usually out.
Usually. But, and this is important, that can change when they become adults. If they gain control or certain rights over the trust at age 18, for example, they might then need to be reported.
Ah, so it's something you have to track over time.
Exactly. And as for regular employees, say a manager at the company owned by the trust, if they're just doing their job and don't have that broader um, ultimate control over the business's major decisions or assets, they typically wouldn't be considered a beneficial owner just because of their job title.
Okay, so it really depends on the specific facts of the trust and who has what powers.
Precisely. It's very fact specific.
If someone listening has like a really layered trust structure, maybe multiple trusts involved, what's the smart move?
Honestly, get professional advice. Talk to a lawyer or a tax advisor who really digs into trust administration and knows the ins and outs of the CTA.
It's worth the investment.
Absolutely. Trying to guess can be risky. The way trust law interacts with these new federal rules is complex, and getting expert help up front can save a lot of headaches and potential penalties down the road.
Right. Okay, so we know who we might need to report. Let's talk about where things can go wrong. The sources flagged some common mistakes, these compliance pitfalls. What should people be watching out for?
A really big one, it seems, is just failing to keep the information updated.
Updated. How so?
Well, say a trustee moves, they get a new residential address, that change. It needs to be reported to FinCEN, the Financial Crimes Enforcement Network.
Just for an address change?
Yep. And if you don't file that update within the required time frame, usually 30 days, those $500 a day fines could technically start ticking.
Wow. That seems like such a small detail to trip over.
It is, but the rules require accuracy.
Yeah.
Another example our sources mention, that minor beneficiary we talked about.
Yeah.
When they turn 18, if that triggers new rights or control for them under the trust, that's a change. They might become a beneficial owner, and you need to report them. Forgetting that transition point is a potential pitfall.
Or maybe if the trustees change, like one steps down and another comes in.
Exactly. Even if the ownership percentage of the trust doesn't change, swapping out a trustee means the beneficial owner information has changed. That needs an updated filing.
It really sounds like ongoing vigilance is key. Who's ultimately on the hook if mistakes are made?
It falls on the reporting company, the business itself, and effectively its owners. The responsibility to get it right and keep it right rests with them. Ignorance or oversight isn't really a defense against the penalties.
Okay, this feels like it could be a real headache, administratively speaking. Are there ways to make this easier? Strategies or tools people can use?
Definitely. And being proactive is the way to go. The first sort of foundational step is just getting organized.
Hell.
Create a really clear, detailed list of everyone involved with the trust. Trustees, grantors, beneficiaries, names, dates of birth, addresses, their roles. Get it all down in one place.
Like a master inventory of people.
Exactly. And then using that list, you need to figure out who actually meets those CTA tests, the 25% ownership or the substantial control test.
Right. Apply the rules to your list.
And critically, don't just do it once. Set up a system. Maybe review it every year. Or anytime there's a change in the trust or the business, like a trustee change or a beneficiary reaching adulthood, make it a regular check-in.
Put it on the calendar.
Put it on the calendar. Now, beyond just good record keeping, our sources also highlighted technology. There are tools emerging specifically for this.
Like software?
Yeah, software platforms. We saw mentions of solutions, for example, from Wolters Kluwer. These are designed to walk you through identifying owners, gathering the info, and submitting the report electronically to FinCEN.
So they guide you through the process.
Right, and often they offer secure storage for all that sensitive data and can even send reminders when it might be time to review or update your filing. That can be a huge help.
That does sound useful for staying organized and on schedule.
Yeah.
Any other types of tools or services mentioned?
Yes. Another name that came up was Trustage. They seem to offer cloud-based systems that help not just with tracking the rules and managing documents, but also things like staff training on compliance.
Okay, more comprehensive support.
And of course, you have the established professional services firms, like KPMG was mentioned. They often help businesses with complex trust tax filings and overall compliance strategy, and navigating the CTA would certainly fall under that umbrella now.
So it ranges from DIY software support to full-service professional help.
Absolutely. Depending on the complexity of your situation and, your comfort level, there are different options. The key benefit across the board is simplifying the reporting, cutting down the risk of errors or missed deadlines, and managing that sensitive info securely.
Okay, we've covered a lot of ground. Let's try to boil it down. What are the absolute must-remember points for listeners dealing with trusts and the CTA?
Number one, if a trust holds a significant stake, that 25%, or exerts substantial control over your business, you must identify and report the individual beneficial owners connected to that trust.
Identify and report. Got it.
Number two, This isn't a one-time task. You have to keep that reported information accurate and current. Updates are crucial.
Ongoing maintenance, right?
Which leads to number 3, be proactive. Create systems to track everyone involved, schedule regular reviews, and seriously consider using the tech tools or getting expert help available. Don't wait for problems to arise.
And maybe the underlying point, don't underestimate the consequences.
Exactly. Those potential penalties, the daily fines, the potential for criminal charges, they make it crystal clear why taking this seriously is so important. A little investment in compliance now can save a massive amount of trouble later.
Okay, so quick summary of our deep dive then. The Corporate Transparency Act adds a significant layer for businesses involving trusts. You need to look through the trust to report the real people, beneficial owners who have that 25% stake or substantial control.
Uh-huh.
Getting this wrong means big fines, maybe worse. But common mistakes often involve just failing to update info when things change, addresses, trustees, beneficiaries aging in.
Simple things, often.
Right. But the good news is there are ways to manage it. Detailed record keeping, regular reviews, and leveraging specialized software or professional advisors.
That sums it up well. It might seem daunting, but breaking it down, being proactive, using the resources, it makes it much more navigable.
Okay, a final thought for everyone listening today. Think about the mental energy you save, the peace of mind you gain, knowing your business compliance is handled. That's energy you can pour back into actually growing your business, right? Instead of looking over your shoulder for regulators.
It's a valuable shift in focus.
So the question to ponder is, what's one concrete step you can take today, maybe right after this, to get a clearer picture of your own trust's obligations under the Corporate Transparency Act?